Taxes are inevitable, but overpaying isn't. Want to know how to keep more of your hard-earned money? Stick around and I'll show you how. What most people don't realize is that a little bit of planning can make a huge difference. We're talking potentially thousands of dollars back in your pocket, or even better, not owing Uncle Sam a dime more than you absolutely have to. By the end of this video, you'll be armed with practical, actionable tips to maximize your tax refund and minimize your tax liability. So grab a notepad, get comfortable, and let's make sure you're not leaving any money on the table. All right, let's kick things off with one of the most powerful tax-saving tools at your disposal: retirement accounts. We're talking about your trusty 401(k) and your individual retirement account, the IRA. These accounts aren't just about securing your financial future, they can also significantly reduce your tax burden today. When you contribute to a traditional 401(k) or IRA, you're essentially telling the government, "Hey, I'm going to stash this money away for later, so don't tax me on it now." This means you get an immediate tax deduction on those contributions, which can lower your taxable income and potentially bump you down a tax bracket. That's a win-win. But it gets even better. Not only do you save on taxes up front, but the money you contribute grows tax-deferred. That means you won't owe a dime in taxes on any investment gains or dividends until you withdraw the money in retirement. Now here's the pro tip. If you can swing it, try to max out your contributions every year. For 2023, you can contribute up to $22,500 to a 401(k) and $6,500 to a traditional IRA. The more you contribute now, the less you'll pay in taxes, and the more you'll have stashed away for a comfortable retirement. Now, let's talk about tax credits. These are like golden tickets to a lower tax bill. Unlike deductions, which simply reduce your taxable income, tax credits directly reduce the amount of tax you owe, dollar for dollar. One of the most valuable tax credits out there is the Earned Income Tax Credit, or EITC. This credit is designed to help low to moderate income working individuals and families, and it can be worth thousands of dollars. If you have children, you might also qualify for the child tax credit, which can put even more money back in your pocket. And if you're pursuing higher education or have education expenses, be sure to check out the education tax credits. The American Opportunity Tax Credit and the Lifetime Learning Credit can help offset the costs of college tuition and fees, making education more affordable. Tax credits are incredibly valuable, but they're often overlooked. So take the time to research the credits you might qualify for. For all my homeowners out there, owning a home comes with its own set of awesome tax benefits. We're talking big deductions that can significantly lower your tax bill. First and foremost, you can deduct the mortgage interest you pay on your primary residence. This can be a huge deduction, especially in the early years of your mortgage, when most of your payments are going towards interest. You can also deduct your property taxes, up to a certain limit. And if you're a first-time home buyer, you might even qualify for a tax credit. Owning a home is a big financial decision, but the tax benefits can make it a little bit sweeter. So if you're thinking about buying a house, be sure to factor in those sweet, sweet tax breaks. All right, let's talk about something that might seem small but can actually have a big impact on your tax bill: your filing status. Most people just assume they have to file as single or married filing jointly, but there are actually 5 different filing statuses, and choosing the right one can save you serious money. For example, if you're single and support a dependent, like a child or aging parent, you might qualify for the head of household status. This status comes with a lower tax rate and a higher standard deduction than filing as single, which means you get to keep more of your hard-earned cash. The best filing status for you depends on your individual circumstances. Take the time to understand the different options and see which one will result in the lowest tax liability. Now, let's talk about something that feels good and can also benefit your tax bill: charitable giving. If you itemize your deductions, you can actually deduct your charitable contributions, which can lower your taxable income and your overall tax liability. First, make sure you're donating to a qualified charitable organization. The IRS has a list of eligible organizations on their website, so you can double-check to make sure your donation is going to a good cause and will qualify for the deduction. Keep track of all your donations. Whether it's a cash donation, clothing, or even old furniture, keep a record of what you donated, when you donated it, and how much it's worth. For cash donations, it's a good idea to get a receipt from the organization, especially for donations over $250. Trust me, you don't want to be scrambling for receipts come tax time. All right, let's talk about something that can save you a ton of money on healthcare costs: health savings accounts, or HSAs. HSAs are like triple tax advantaged accounts, which is pretty much the holy grail of personal finance. Contributions you make to an HSA are tax deductible, which means you can lower your taxable income and save money on taxes right away. The money in your HSA grows tax-free, so you can invest it and watch your savings grow without the IRS taking a cut. When you use the money in your HSA for qualified medical expenses, you don't pay any taxes on those withdrawals either. To qualify for an HSA, you need to be enrolled in a high-deductible health plan, or HDHP. Chapter 7. Tax-advantaged accounts grow your money smarter. Let's face it, taxes can eat into your hard-earned savings. But guess what? There are special accounts designed to shield your money from the taxman while it grows. We're talking about tax-advantaged accounts, and they're like secret weapons in your financial arsenal. First up, we have 529 plans. These are specifically designed for education expenses. You put money in, it grows tax-free, and when you take it out for qualified education expenses like tuition, room, and board, you don't pay a dime in taxes on those earnings. It's like giving your kid a head start on their education without the IRS taking a cut. Then we have flexible spending accounts, or FSAs. These are great for covering medical and dependent care expenses. You contribute pre-tax dollars, which lowers your taxable income. All right, investors, this one's for you. Did you know that how you invest can significantly impact how much you pay in taxes? It's true. By making smart investment choices, you can keep more of your hard-earned profits and minimize your tax liability. First, let's talk about capital gains. When you sell an investment for a profit, you owe taxes on that gain. But here's the kicker. If you hold on to that investment for more than a year, you qualify for the much lower long-term capital gains tax rates. And if you have investment losses, don't despair. You can actually use those losses to offset your gains, which can lower your overall tax bill. Another tax-savvy investment strategy is to consider municipal bonds. The interest you earn from these bonds is often tax-free at the federal level, and sometimes even at the state and local levels. It's like getting a tax break just for investing in your community. Life is full of surprises, right? New job, getting married, having kids, starting a business. These are all exciting milestones, but they can also significantly impact your tax situation. That's why it's crucial to update your tax game plan whenever you experience a major life change. For example, getting married opens up a whole new world of filing statuses. You and your spouse can choose to file jointly or separately, and the best option depends on your individual incomes and deductions. Having kids brings along a whole bunch of tax benefits, like the child tax credit and deductions for childcare expenses. Changing jobs or getting a significant raise can also affect your tax bracket. And if you're starting a business, get ready for a whole new set of tax rules and regulations. Attention all entrepreneurs and self-employed individuals. Did you know that running a business opens up a world of potential tax deductions? It's true. From home office expenses to business mileage, there are tons of ways to lower your taxable income and keep more of your hard-earned cash. Let's start with the home office deduction. If you use a portion of your home exclusively and regularly for business, you can deduct a portion of your rent or mortgage interest, property taxes, utilities, and even depreciation. And if you use your car for business purposes, you can deduct those miles. Keep track of your mileage throughout the year, and you'll be surprised at how much this deduction can add up to. And don't forget about all the other expenses you incur while running your business, like office supplies, marketing materials, and even travel expenses. There you have it. We've covered a ton of ground today, from maximizing retirement contributions to leveraging tax credits and deductions. If you found these tips helpful, imagine the impact of staying informed all year long. Subscribe to Money Mind Matter for more valuable insights on managing your finances, and hit the notification bell so you never miss out. Let me know in the comments if you have any tax tips of your own, or if there's a topic you'd like me to cover next.